Welcome investors! Today we'll be talking about Silicon Valley Bank collapse. I'll give you the official reasons for Silicon Valley Bank collapse and I'll give you my reasons why I think Silicon Valley Bank collapse. So first I will tell you about official reasons. So why did $200 billion tech lending Silicon Valley Bank abruptly collapse, triggering the most significant financial crisis since 2008? There is no single answer. There was, as some argue, result of the Trump era deregulation or mismanagement at the bank, or sharp interest rate rise after a decade of ultra low borrowing costs, or perhaps combination of those three reasons. But I think something different. I think that the problem lies something else. But before I start talking about this, I'll tell you briefly about this what F.D.I.C did. So F.D.I.C invoked a systemic risk exception, which allows the government to pay back uninsured depositors to prevent dire consequences for the economy or financial instability. And the Fed announced that it would set up emergency lending program with approval from Treasury to prevent additional funds for eligible banks, basically to meet the needs of all depositors. This means that all the deposits, even those above $250,000, were paid off. In regular bank, if you have over $250,000, you are not going to get back your money if the bank goes belly up, because the money is only insured up to $250,000. But with the Silicon Valley Bank, it happened that everybody got paid. Why? Because majority of depositors had over $250,000. This is unusual. If you take a look at your regular bank around the corner when you're banking, most of the people keep in this bank around $5,000, $10,000 to $15,000. They don't keep $250,000 on their bank account. But Silicon Valley Bank is an exception because it serves startups from tech industry, which had a lot of money raised from the investors, and that's where they deposited all this money. Fed decided to do this because they were worried that this can spread to another banks, which personally I think it's not fair, because if you, for example, had $300,000 in your local bank and your bank goes belly up, you would not get your money back, because majority of people who are banking in your bank have only a couple $1,000s in their bank, and they'll be paid first. Whoever had over $250,000 would not get their money back. But in Silicon Valley Bank, majority of those deposits were over $250,000. That's why they got paid back, which, like I said again, it's not fair, because it is unusual situation, it's an exception, but they should be treated like everybody else. F.D.I.C has the rules, $250,000 and that's it, no more. But here they are doing their exception because of the systemic risk to the system. Not fair. Let's go back to the reasons for the bank to collapse. Like I mentioned on the beginning of this video, the reasons were deregulation during Trump presidency, high interest rates, or mismanagement in the bank. For sure, those reasons contributed to the collapse of the bank. But I think that there is something else which was not mentioned during this entire situation. Silicon Valley Bank has been around for 40 years, and they only strictly focus on startup companies from the tech industry. They never even try to go and increase their customer base and get customers from different fields, from different areas. Blue collar customers, white collar customers, big companies, small companies, they strictly focus on the startups. In my opinion, if they, for these 40 years, started diversifying their customer base, they would be able to withstand this run on their deposits and they wouldn't collapse. But they didn't do this. For past 40 years, there were good times, low interest rates, they were doing really good, so they didn't even bother to go outside of the box and look for regular customers to increase their customer base in order to prepare themselves for the rainy days. They were thinking that the good times are going to be rolling always and forever. But like with everything in life, there are good times and then suddenly you have bad times. On Friday, the bank announced that they are in a little bit of trouble, and on Monday, the bank already did not exist because the Fed took over. And the reason for this, in my opinion, is that they didn't diversify their customer base. They didn't look into the different environment. They didn't started going and looking for different customers besides the Silicon Valley startup tech industry. And that was the reason why within a couple days, when there was a run on their deposits, they basically fell. None of the banks can withstand the run on their deposit. JP Morgan Chase, Bank of America, Wells Fargo, if you look at those huge banks, and if tomorrow all the customers go and start withdrawing their deposits, all those banks will die. But it is not going to happen because they have hugely diversified customers base. They have people with very low income, they have people with very high income, they have people with few $1,000s deposits, they have people with couple $1 million deposits, small companies, big companies, whole broad spectrum of people living in United States, and not only in United States. So if one group decided to pull their deposits, there's always another group which is not going to do this. Silicon Valley Bank did not have this comfort. They have only one group, small tight group of tech founders which all know each other on the social media, and when the world spread out that they are in trouble, those guys quickly communicated between each other, spread the news. They ran into the bank, started pulling all the deposits, and the bank was done. And that was 100% of their customers. No diversification. And this applies not only to this bank. It's not only a danger to the bank having only the niche, serving only a small niche. It also applies to your portfolio. If you have 1, 2, or 3 stocks and 1 or 2 of those companies goes belly up, your portfolio might be wiped out. That's why it is good to have S&P 500 index fund, because you have 500 companies which are diversified. 1, 2, 3 of them goes belly up, there is 497 left. So that is my reason for Silicon Valley Bank collapse, and I didn't read this anywhere. I haven't heard this anywhere, that the reason for collapse of this bank is a lack of diversification. So please let me know, what do you think about this? Do you agree with me or you disagree with me? Do you think that this bank was able to predict this situation a couple years earlier, and they could have started taking necessary steps to diversify or investing the money differently than into long-term treasuries? What do you think? Please let me know. I would like to hear from you. Your comments really matter to me, and I really enjoy reading all your comments. So thank you so much. I really appreciate your time, and I want you to stay healthy, because this is the most important asset in your life. It's more important than your stock, bonds, Bitcoin, gold, silver, and whatever else you have your investments put in. Health is the most important asset. So take care about your health, get enough sleep, get some exercises at least 2-3 times per week, keep your diet clean, stay trim, don't get overweight. You will avoid a lot of health problems. So keep your biggest investment asset as the most important asset, which is your health. Thank you again for being with me here. Have a great day.